In this video, we're going to talk about Paysafe, trading under the ticker symbol PSFE. It's a company that has been operating for a while, and even though it may have the veneer or the impression given to people that it's a startup, at least that's how I felt when I first saw the online following of the company. It's actually a company with a significant track record to show the people that it's a legit company, that it has significant operations, and it does have past to back up for the present and arguably the future. So this is why a lot of people were hopeful when the stock first began trading. And I think the reason why the momentum was broken was because at some point they released their quarterly results and it was below the expectation. And because of that, a lot of financial analysts, they modified the valuation of this company. And because of this, a whole bunch of chain reactions have been initiated. So people were reevaluating whether they should be owning Paysafe at the current cost basis, and for many of them the answer was no. And this is why there were a lot less buyer and a whole bunch more sellers after this point. And this kind of explains why the stock was under a tremendous amount of selling pressure for a very long period of time, for almost the entire existence of Paysafe so far. And I remember saying this at the time when I first covered Paysafe, is that it's not going to fall forever. You have to prepare for the eventual scenario that it stops falling and find itself on a good support level. And this is when you should start considering to enter the stock. Well, right now it seems like we are at least at a very strong support looking at where the stock is. And it's been staying there for a while. And also keep in mind that during that same period of time, other companies in the same sector or in the same category or the mental category that retail investors or institutional investors alike have put Paysafe in. Some other companies like SoFi have been falling and falling sharply in price. I'm not even talking about companies like Palantir. All the growth type companies are falling, but Paysafe has found a support level. This means that this support level is very significant, that we have reached, at least in the medium term, a sort of floor. It's not going to fall lower than that. And in my opinion, that warrants investors to give it a second chance. I think that now is a good time to increase your holding in Paysafe. Is it going to keep falling? Of course, it may go stairways. Like some companies, you think that this is the bottom, but it's never the actual bottom. I felt for many times that maybe it's the bottom with Hydeon, and I wanted to buy in Hydeon when it fell to historic low way back in late 2021, but it just kept falling. This is why I never increased my exposure in Hyliion ever since that point onward. I need to see some reversal signals for me to keep increasing my exposure. But in this case, there's nothing that says that Paysafe is going to keep falling either. So my suggestion is to go through your portfolio and see how much capital you can lose or you can risk without putting your entire portfolio in jeopardy, and consider increasing your holding of Paysafe. Personally, I would recommend to keep an eye on Paysafe for volatility play and to keep a smaller position of your allocation to be held in long term. The maximum exposure I would recommend is between 0.5 to 1% of the portfolio. Like I said, a good entry point is now with between 25 to 50% of your allocation in the position at the current price point. The holding period should be at least 2 to 4 weeks before you consider selling. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon, because the financial sector would see its profit margins reduced, and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.